Hey, what's up? It's Ben here. Bonds and stocks are two of the most well-known financial instruments. The common knowledge for new investors is to diversify their portfolio, whether it's between stocks, bonds, or other securities. If you're only starting now and have no idea what a stock or bond is, in this video, I'm going to talk about stocks, bonds, and highlight the differences between these two financial assets, including the risk involved when investing. So first, let's talk about stocks. Some people like to refer it as shares or equity in a company. They are securities that grant investors ownership in a company though. When you own shares in a given company's stock, you share in the ownership of the company and its profit. If you're an investor looking for capital appreciation, dividend payments, and the ability to vote and influence the company, stocks are an invaluable investment. And in order to even consider buying stocks or shares in a company, they'll have to be out on the open market to be publicly traded and have their initial public offering or IPO. The reason why companies want to be traded publicly is so that they can easily raise more capital for them to grow or for future expansion. With that in mind, now we have different classes of stocks we have to think about. There are two main primary types of stocks, and they are common stock and preferred stock. Common stocks gives owner the right to participate in voting at shareholders meeting and receive dividends from company if the company decides to issue dividends though. Common stocks through capital growth yields higher returns than most investment. However, if a company goes bankrupt, the common shareholders may not get their investment back until creditors, bondholders, and preferred shareholders are paid first. And speaking of preferred shareholders, this leads us to the second type of stock, and it is preferred stock. Preferred stockholders have priority over common stockholders if the company goes bankrupt and its assets are liquidated. Investors are usually getting a fixed dividend or payout from their stocks. This is different from common stock that has variable dividends that are never guaranteed and they lose voting privilege. Also note this, stocks are categorized by the size of the company as shown in market capitalization or market cap. There are large cap, mid cap, and small cap stocks. And in order to see if a stock is considered big or small, we simply take the total number of outstanding shares that they have and multiply it by the stock price. So if a company has 20 million shares outstanding and their current price per share is $50, then their market cap will be $1 billion. That would be considered a small cap stock. Mid cap stock would be from $2 to $10 billion, and a large cap stock would be anything above $10 billion. Hope this gives you guys a brief overview of stocks. Now let's talk about bonds. A bond is a financial instrument that represents money being loaned out to companies or to the government. However you want to think about it, it's basically borrowed money. Corporations or governments sell bonds to investors as a means to raise capital to finance projects. For example, when governments issue out bonds, they may use the funds from the bonds to build roads, school, hospitals, or other big projects. In the same way governments issue bonds, companies borrow money from investors in the form of bonds to fund their operations and grow their business. The company issues a bond that includes all of the terms as if it's a loan, including the interest and the time the bond would be paid off. In return, the investors enjoy the interest that comes with the bond while it slowly reaches to the maturity date or due date. Bonds are known for their fixed income security. As an investor, you earn a fixed amount of interest every year for as long as you own the bond. And again, bonds have a maturity date when the principal amount should be paid back in full. Now, not all bonds are created equal. Investing in bonds carries a degree of risk. As an unstated rule, the higher interest on a bond, the higher risk on the investment because the likelihood of them not paying back could be high. And within the topic of bonds itself, there are many different types and structure of a bond. Like you have fixed rate, float rate, zero coupon, inflation-linked, perpetual, war bonds, and many more. But to get a better understanding of bonds, let's look at some common categories of bonds so you know who most likely will issue bonds. Usually, you'll hear either government, corporate, or municipal, but there are more than just these three. First, government bonds. Government bonds are put out by government to investors. Government bonds are considered safe and secure bonds because the government will rarely default on their agreement. If somehow they cannot pay back, the whole economy will just collapse, and because they're considered safe investment, their interest rates are usually very low. Second, municipal bonds. Municipal bonds are issued by states and municipal councils. Municipal bonds usually reward investors with a higher interest rate, but they are a little bit riskier than the government treasury bonds. Third, corporate bonds. These bonds are issued by companies or organizations, and compared to the government type bonds, these are way riskier to invest, but you get a higher interest rate compared to the government bonds or municipal bonds. Since you now have a basic understanding of stocks and bonds, let's talk about the benefits of investing in these assets. Let's start off with the benefits of investing in stocks, and this depends on the type of stock you own. Number 1, you can have voting rights with stocks. Number 2, you actually own a piece of the company. Number 3, you can get dividends from stocks. Number 4, your return on investment is higher with stocks when compared to bonds. As for the benefits of investing in bonds, first, bonds are known for its steady source of income. Second, bonds are predictable and you know what you're getting yourself into when investing in bonds. Third, bonds are relatively low risk compared to stocks and are good for starters. Fourth, bonds are like a safe haven for your money. Most of them can beat your bank interest rates or your saving account's interest rates. But it's not always fine and dandy with these two types of investments. For any types of investments, there will be risk. And here are the risks associated when investing in stocks. Number 1, stock prices are volatile. Some stocks can gain or lose 10% in value just overnight. Because of this, there are no way you can predict the price movement of a stock. Number 2, if a company goes bankrupt, common stockholders are the last to be compensated. Number 3, news play a huge role in the stock market. If there's good news, stocks will go up, and if there's bad news, stocks will go down. There's no way to control a company's stock price when this happens. Now, here's the risk of investing in bonds. Number 1, investors run the inflation risk. Inflation reduces the purchase power of a bond's future principal. Number 2, bonds are considered low-risk investment, hence the returns for bond investments are usually low compared to other investments, and if inflation is like 2% and bond is like 1%, then you're basically losing money. Number 3, sometimes it's hard to liquidate or sell off your bonds when the market doesn't favor bonds. Number 4, bonds mostly revolve around interest rate, and unlike stocks, you can't make a lot more if a company is doing well. So now that you know a little bit more about stocks and bonds, what are the main differences between these two assets? While they're both great to raise capital for companies or government, the key difference is that when you invest in a stock, you are investing in a company or being a partial owner of it. And for bonds, it's like you're basically giving a loan to the company or government to help the organization expand while you get to reap the benefits of a fixed income. Now, this begs the question, which one should you invest in? If you've been watching my videos, I always preach that you should diversify. So why not invest in both? You get the benefits of both sides. Bonds for stability and stock for growth. They're both relatively easy to get into nowadays, and the only hard part is that you have to choose the right stock and you have to do research. Research is no fun, but it will definitely help you out in the long run and will be a valuable skill set when you're investing long term. So if you're looking to invest in the long run and you still haven't decided where to open a brokerage account to invest, then maybe consider checking out Webull. I have a portion of my investment with them, and what I like about them is that they give you free stocks just by signing up and depositing $100. Currently, they are running a promotion where you can get 4 free stocks, so get some free money while it still lasts. But besides the free stock, you can also paper trade, and this is where you can basically practice investing without risking any of your money at all. It's basically using simulated money to invest and trade. There is a lot more stuff that Webull offers, and you can check out my playlist to get a better idea of Webull itself. But anyway, hope you all now have a little bit more knowledge of stocks and bonds and feel a little bit better when investing in them. If so, feel free to give this video a like and maybe consider subscribing for more weekly uploads. And I'll catch y'all later.